So here we are, Liberation Day. We've got stocks down massively. The S&P 500, Nasdaq, Dow Jones, Russell 2000, all dropping like a rock after Trump announced the reciprocal tariffs on multiple countries. We're seeing Apple, the big, the FANG names, Amazon. We're seeing Nvidia dropping lower and lower on fears that this trade war has just begun and things are not going to end up looking good down the road. Now, with the reciprocal tariffs, you definitely can look into more in details, especially on X, from the White House. If you could look at just their Twitter or X handle, I should say, more details of every country and the amount of tariffs that they plan to put on. But basically, they decided that they're going to put an additional 34%. So I'll highlight a few countries here. Additional 34% on China, which they already had 20% tariffs before this, which basically totals a 54% tariff on China being hit. European Union, additional, they're going to add 20% tariffs there. Vietnam, 46%. Taiwan, 32%. Japan, 24%. India, 26%. Right? The UK, 10%. We don't see Canada or Mexico on this list, but the current tariffs that are already there remains, along with the 10% baseline for all the countries out there, right? So there's a whole bunch, this whole list, as you can see here, came out, and the White House basically released this list, so you can check it out. But you have all these tariffs on multiple countries, basically signaling to you here that, things are about to get more expensive, prices, inflation expected to go up higher, and there's risks to growth in the future, right? We're already hearing right now a lot of plants, manufacturing companies, businesses out there pulling out of these countries, laying off workers as well. We're about to also see in the upcoming jobs data to show weakness there, especially with all the layoffs that have been happening in the government, and also with many of the companies, retail companies and manufacturing companies, like we've seen in the previous earnings report. So, this just adds more fuel to the fire, and this definitely, is being seen negatively in the markets, which is why you're getting the sell-off, which is why you're seeing bonds move up, the VIX move up higher. And this is basically, setting up the tone for what type of pain we could see down the road. Now, in terms of the bond market, what's very interesting is that we did get some numbers coming out, the ISM number coming out that does measure how the U.S. economy is doing. It came out weaker than expected. You got the employment component also very weak as well. Prices a little bit lower as well. But what was very interesting is that we did see the bond market move up on the tariff news, but then after when the ISM numbers came out, we saw a little bit of a pullback. And while the stock market was moving down, what was interesting is we saw stocks and bonds and the dollar all moving down together, which is alarming, because usually if you got a risk off kind of environment, you would see bonds move up more aggressively than what it is right now, and stocks continuing the sell-off, basically giving you the signal that this is a risk-off type of day and money is being moved into safe haven. Now, I'm not saying that money hasn't been moving into safe haven and that things are being that the bond market's not being bought. I'm just talking about today's reaction after the market opened and after the data, how we didn't see more aggressive buying in the bond market. And actually, we saw some pullback there, which was very, very, very interesting. The people, the crypto bros out there may, come out and say that, hey, this is a signal that, you're seeing the dollar and the bond market, the US Treasury market move down lower, signaling to you that, hey, is this the end of, the US throne and the US world reserve currency? Maybe, maybe not. We'll see how ugly this comes, this trade war ends up being, especially if you're going to get retaliation from a lot of countries, right? We heard that Canada is expected to retaliate on autos. We heard that from the EU, there's going to be some retaliation there, and so forth, right? So definitely there's going to be back and forth, and obviously you can expect China to do the same thing as well. There was also a CNBC article. We have to be careful with articles nowadays as well, because we tend to see articles come out and then be completely denied from Trump. It could be a strategy of his as well to give false information to the news and then kind of lead them the wrong way while completely saying the opposite once he comes out on his social media platforms or through his speeches. But point is, what I was trying to say is that the CNBC article that came out discussed about these basically that the White House is not in the mood for any talks right now and negotiation talks right now. So we did see that article come out. Now, is it true? Is it not? That is something to keep an eye out on. And we'll see, whether that is true or not. But if that is true, then that's definitely bad news. Now, another interesting thing is you got the basically the traders out there pricing in a potential rate cut on June 18th and another one in July. So they're now expecting rate cuts to come sooner and maybe more due to all this trade war issues and that basically affecting the growth in the economy, right? On top of that, we heard from a couple of Fed members as well. So here are some comments, from the Fed that are shifting towards being more hawkish due to the terrorists. And like I said, I've been talking about this before, right? Even though traders might be pricing in rate cuts, if the economy is not breaking that bad and the job markets are not that bad, then they're definitely not going to be cutting rates. There's no way. And if inflation runs away and ends up getting worse off, then, like I said in my previous video, they could open up the door opened up the door more towards rate hikes. So we'll see what happens there. But here are some comments that came out from some Fed members for you to note. What's the Fed, right? The Fed, the one who's thinking about rate cuts, rate hikes, monetary policy. What are they thinking here before we get to the meeting? So here's the first one from Kugler. There may be reasons why tariffs have more prolonged effects. That's basically shifting towards more the hawkish side, hinting towards rate cuts not coming anytime soon. Another Fed member, Goolsbee, fear is if tariffs on imports jumps out of just imports and move into other costs, or people freak out and change behavior. Williams said, my forecast is that inflation will be relatively stable this year with upside risks. Full impact of tariffs can play out over long horizon, right? So not just the short term, we could see in the long term as well. Daly said PCE data decreased her confidence in her forecast for 2 rate cuts this year. So there you go. More rate cuts? I don't think so. Barkin warned not to assume just a one-time change in prices from tariffs. So not a one-time change. You could see this drastically, again, the long-term effects. Collins, inflation risks are to the upside. It remains question of how long tariff-driven inflation will last. So we also have Powell speaking this week. If Powell takes more of a hawkish tone, that could definitely send equity prices lower, and that's why maybe you might even get the bond market to maybe move down lower on this hawkishness, right? So all in all, what do I think of all this? Well, I mean, my indicators that I'm watching shows that yes, things are getting rocky. Things are getting a little bit, not so good. We're not at the point where we should be screaming the crash. I don't think so. Yes, the equity markets have been pulling back, and we are seeing the sell-off. We've seen this previously with Trump in his previous term, and we did see 20% sell-offs, and then the market's bouncing back. We can get full year or so of just range motion as this tariff news continues on and as traders digest. And there is now more upside risk to inflation, and there's more risk towards the economy getting worse off, credit spreads getting worse off, employment numbers getting worse off, growth numbers getting worse off because of all of this. But I think it still can take time, and I wouldn't be surprised to see some sort of bottom or short-term bottom where the equity markets then start rallying up and squeezing higher. And don't forget that it's possible in a bear market to get 10 to 20% rallies. It is possible, right? Now, again, predicting what Trump will do, I don't have a crystal ball and I can't tell you, right? If all of a sudden all this trade tariffs end up, not getting worse off, and the countries are now working with the U.S. and all as well, then great, yeah, then things will start to heal and the equity markets will go back up. But if the fight continues, then you can expect a lot of pain ahead. You can expect job losses ahead. Now, in terms of the Fed's reaction, don't expect them to react right away, because they've got two mandates. One is, yes, the job market, and the second is inflation. But if they expect inflation to tick up and the job market is not crashing, they're not going to cut rates. They're going to try to tame inflation. And we know last time when they tried to tame inflation, they failed at it. They were behind the curve, and then they had to do all that aggressive rate hikes. So could we see that scenario again? Possible if the economy doesn't contract aggressively. If the economy contracts aggressively and you get the job market basically cratering and things are going really bad, then yes, you're going to get the rate cuts. But I don't think that will change things in terms of inflation prices. Yes, a crunch in demand and growth will bring prices down, but when they come out and they start cutting rates and pumping money back into the economy to revive the economy, I feel that will just bring back inflation again and maybe shoot it up, right? Which will cause a reaction from the Fed to come back again and hike rates again. So it could be tough years ahead. It could definitely be tough years ahead. So in that sense, the bond market, if they're cutting rates, can be a good asset where traders may park their money. I do like personally Bitcoin and crypto, although it also follows kind of the risk assets there. But long term, it can play out well, especially if two things. Well, if things turn around in the equity markets, or second, you get the crash and then this rate cuts and the money printer goes burr, then definitely you'll get the huge rally in the crypto market. So there are discounted prices there. There are opportunities, trading opportunities out there. Of course, you have to be vigilant and you have to be, careful with the risk that you take, because this can swing any way with knowing with how Trump is and the news flow, you can get different news every single time. So let's look forward to, just for the time being, the Fed coming out this week, and let's look forward to more data, and let's see how this all plays out. But for now, like I've been saying, we are snowballing slowly into that disaster moment. Are we there right now? Again, indicators show not right now, but we're getting there. We're getting there, and there are cracks, there are signs. It will just take something a little bit more, bigger push to cause that economy to basically crash and implode, right? And again, there will be opportunities. There will be opportunities from a market point of view, and so forth. But anyways, let's continue to monitor and see how that goes. Let me know what you guys think. Leave a comment below. Subscribe, hit the like button, bell icon to be notified of the next video. And I'll see you guys around. Cheers. Bye.